Welcome back, everybody. Good to have you. Today we're talking about recession concerns and the Milwaukee real estate market. It's August 2022, and I'm excited because I have some interesting slides for you today. As always, let's get started with the latest numbers from the MLS. And here we have the numbers from July 2022. As expected, inventory is up almost 4,000 units on our Metro MLS. That's up 11%. That is great. That's a lot more than we had to choose from a few months ago. But on the other hand, if you compare it with our benchmark year of July 2015, over 13,000 units, you can see we are used to having a lot more to choose from. Home sales, on the other hand, are down, and that's a number that shocked me a little bit. We've seen the market slow down significantly, but 20% is a lot. Normally, the Milwaukee area is pretty stable, around 3,000 units per month. You can see that also in July 2015, we had around that number. So going down to 2,600, that is really a tough punch here. And the irony is that the market is still moving super fast. So 6 days only for the median home to sell compared to 50 days. So this is an extremely fast-paced market. And that seems like a little bit of a contradiction. What's happening is that everything that's coming on the market that is a good listing for a fair price gets snatched up extremely fast. But at the same time, we just don't have enough inventory, and also we have much higher interest rates than we used to. And that is leaving an impact on prices. So also not unexpected, we're coming down from the spring peak prices. I think last month I had here about $311,000, and now we're down to $302,000. That's still a 9.8%, almost 10% appreciation over last year the same time, but we're already coming down from the highs that we had in spring. So what does that mean for the market? This is a seasonal slowdown we're seeing every year in summer, people up north on vacation. So this is very typical, but the market is really very heavily impacted by the higher mortgage rates. And we're going to take a look at that in detail. So what does that mean? That means fewer offers per listing, especially in the market over $500,000. We have been able to negotiate some really good discounts on properties in that segment. On the other hand, the middle and the lower segment, $300,000, $400,000, they're still extremely competitive. That's a very crowded place. A lot of buyers are there, and you're still seeing 5, 10 offers, and of course prices over asking price. That is different than the 15, 20 offers that we've seen in spring. So it's a reduction, it's a slowdown, but still a very competitive market segment. All right, before we get more into it, here is a quick disclosure. You might be wondering, where is all that information, where's all that data coming from every month? And so it's not like I'm sitting in my office and making this up. What I'm telling you every month is based on a lot of research that I'm reading. I read that stuff usually about an hour in the day, normally in the morning. A lot of it is paid research. So there's economic research. There is a lot about the housing market, and I take all that and what I see there happening and what I'm seeing being forecasted on a national level, I compare it with what I'm seeing here locally in the Milwaukee market. I'm trying to look at it in a kind of holistic way and then piece it all together, make sense out of it, and put this in a 10, 15, 20 minute at the most video, so you can stay updated on everything that's going on about Milwaukee real estate. So if you appreciate that summary here, then please do me a favor and give this video a like. It will help my channel a lot, and it will help this information to get to other people that could benefit from it as well. So thank you very much for giving the video a like, and this is where a lot of my data is coming from. All right, moving on here. This data here specifically is from the MLS, and I have here two charts that are interesting. The left one is showing you the number of listings that we have here in the metro area, and the red line is giving you active listings, and the brown one is new listings. And let me show that here. So whenever these lines are crossing, this is very interesting. It's like Ghostbusters, don't cross the streams. So inventory is increasing even though we are not getting as many new listings as we have gotten before. What is that telling us? The market is slowing down. And you can also see this here on the right side, sold to list ratio. It came way down in July. So there is a lot more room to negotiate than we had in the 3 months before. So we are really seeing that shift, and now it's manifesting in the data. You've heard me talk about the last 3 months about it, and now we can see it here. So where's all this coming from? The biggest impact that we have, factual impact with, of course, there's emotional impact from inflation and from recession fears, but the biggest rational impact on the market is actually from mortgage rates. So beginning of the year, and this data shows mortgage rates here from January all the way to August, and you can see how we continually ramped up mortgage rates. And in June, we hit almost 6%. That means for a typical average buyer, maybe practically speaking, 6.5%. If the credit is not super perfect. So that is about, on a typical Milwaukee mortgage, I would say that's about $400, $500, even $600 monthly in difference. So of course that has a big impact on the housing prices. Now rates are stabilizing. This has a little bit to do with what the Fed is doing, but actually mortgage rates are not dictated by the Fed. They are actually created in the marketplace. And so we will see what is going on with recession in the next months, because that is going to have an impact on mortgage rates. I've mentioned this last month here, that whenever we have seen a recession in the past, at the end of the recession, mortgage rates were typically on average 1.8% lower than they were at the beginning of the recession. And we're not even sure if we are in a recession. So that puts us to the next question. So here you have all the recessions listed from the 1940s until now, and you can see here two things. Number one, they always were at least 2 quarters of a negative GDP. So that is kind of the thing that we're debating, or that the politicians are debating right now. We already have 2 quarters by now, and we're still not sure if we're actually in a recession. So it is a very weird recession. It doesn't really fit into what we have seen in previous times. And so I think it will be very interesting to see what is happening in the next 2 quarters. The one reason why I say this is a really strange and weird recession is because the job market remains extremely strong. And that is untypical. When you think about it, what do you expect really from a recession? Unemployment. We're in a recession. Your friends are telling you they got laid off. Everybody's worried about getting laid off. That is basically what we had back here in 2008, if you recall. Before, we had an unemployment rate of about 4.5%. And then within these 4 quarters, we shot up to 10% unemployment rate. And it took us more than 10 years to come down. And COVID hit here with that spike. And now we're down in July at 3.5% current unemployment rate. So that does certainly not look like a recession. And by the way, Wisconsin doing even better than the national average, 2.9%. Yay, Wisconsin. I think that's great. So this is untypical. It remains to be seen what's going to happen with the job market, because that will have a bigger impact on the real estate market than what we have seen so far, which is basically no impact. And here's a survey from the Wall Street Journal, and I'm following this. So they are asking economists if they're expecting a recession around the corner. And the latest number here is from July, and it's now almost half of the economists are expecting a recession to happen very soon, in the next 12 months at least. So if you don't want to call it a recession already, then we should be in one very soon. And you can see how that trend has been increasing basically since last year. Now, the big question in our context is, what would a recession actually mean for the real estate market? And this is what I want to investigate. First of all, here's a slide that you may have seen in one of my previous videos, but I think it is so important that I have to keep bringing it back, because that's the key thing. A recession does not automatically mean that home prices are going to drop. You can see here the last 6 recessions, and home prices went up during almost every recession, actually quite a bit. You know, you see here 3 of them had a 6% number in front of them. We had a little slip here in 1991, and then of course we all remember 2008. But here's the thing. This was not a recession that caused the real estate market to crash. This was a mortgage crisis that caused a wave of foreclosures that eventually caused a recession. So cause and effect are, turned upside down here. So it was really a wave of foreclosures that got us into that situation. And we are not looking at a wave of foreclosures right now. I have here the latest data from Adam. And what that is telling us is that last year we had a very, very low foreclosure number, 151,000 altogether. Compared to the top, we had almost 3 million in the US here in 2010. And to give you a little context on that, the annual production that we see on average, new home production that all the builders combined in the US are putting out, is about 1 million housing starts. So you can imagine what happens to a market where over 3 or 4 years, you basically have 3 or 4 times the volume of supply, pumped into a market than what you normally have just by production of new construction homes. So of course, this did a number on the market, but we have almost no foreclosures. Here is the preliminary number that I have for 2022. It's 164,000 so far. And what I think we will see very soon in the news, that they are going to talk that foreclosure numbers are up. They are up double, they are up 50%, whatever they're going to say. Just know this, if you have very little and then you double it, it's still not a whole lot. So it might as well be that they're doubling this year from last year. That is just what a normal healthy market is doing. We are far, far away from the 3 million foreclosures range that we used to have back in 2009, 2010. All right, so here are a few thoughts on why pretty much every real estate expert and every economist in the country agrees that why the real estate market is not crashing. And I know that's not super popular. There's a ton of content on YouTube that's been predicting for the last 10 years that the real estate market is about to crash. And here I am, and I'm stating the opposite. But bear with me and I'll give you the reasons. So the number one picture that I want you to keep in mind is that supply and demand are always defining a market, especially a real estate market. And we have just such a strong buyer demand for a number of reasons. I'll go into that in a second. And that demand is not going away. So unless you just lose 20% of the US population and you find a whole bunch of houses that nobody knew before they were there, that supply and demand equation is not going to shift quickly or easily. There is just not an easy way to magically wish houses into existence that are currently not there. We will have to build them, and that takes a lot of time. So when you look at the market in total, this is a super overview that gives you an idea where we're at. So generally, we're looking at a buyer's market. If we have a lot of inventory, we measure that in months of supply. So if we have more than half a year of inventory, we are considering it a buyer's market, neutral market, about 6 months, and a seller's market if we have less than 6 months. So you can see here in 2008, 2010, we were very, very high on inventory. And right now we are, even though it's going up, we are still super low on inventory. And for that reason, this will not change. You can see it takes years for this chart to move. So we are not expecting to get up here into a neutral market anytime soon. It will just be a while before we get there. So here's the reason why we have not enough inventory. And you may have, if you follow my channel long enough, you may have seen this chart last year. I wanted to bring it back because it really explains in one sentence why our gap in inventory is coming from. It's coming from here. So these were the foreclosure years. And after that wave of foreclosures, a lot of builders went out of business. They stopped producing new construction homes, and new production went from up here to down here. And this is the long-standing 50-year average. So we created that gap here. There is a deficit, a big deficit of new home construction. Population has grown in the last 2 decades, but we have not built the houses that we need. And now we need a few years of overproduction in order to get back to a balanced market. And that will just take a little time. Now, what are the builders doing? They are slowing down. That's exactly the wrong thing that we need right now. They are slowing down because they're seeing interest rates going up, and the builders don't want to be the ones holding the bag. So you can see housing starts in May and in June significantly down from April because they just want to see what's the impact of the higher mortgage rates on the market. So unfortunately, fortunately, there's not much new supply coming in from the builders, especially in Wisconsin. So I have a chart here that gives you the 5 states with the most current new home production. And, you have to really let these numbers sink in. Texas alone is pumping out almost 100,000 new homes this year. Florida, about 76,000 new homes. So in comparison to that, we have Wisconsin here with about 6,000. So new construction is not really that big of a factor. If you're driving around here in Milwaukee, you see, in Menominee Falls, in Brookfield, you see once in a while a few houses being built, but it is just not a big factor. It's not contributing a whole lot to inventory. In other states, this is very different. They have very high levels of production, and that absolutely has a possibility to impact the market. So when you hear the news, this is happening on a national level, keep this in mind. In Wisconsin, in Milwaukee, we're a little bit an economy of our own, and we're just doing this on a completely different scale. The one thing that we can't escape is the increase in prices. So this is a construction price index. And you can see here the index of 100 is about here in 2010, 2012, and we are now at 180. So in a little more than 10 years, it has gotten about 80% more expensive to build new construction homes. This is one of the reasons why we're seeing not more new construction, and this is one of the reasons why existing homes that we have, the housing inventory that we have in the Milwaukee area is so popular, because most of the houses that we already have are much cheaper. You can buy them for much less than what you would have to pay if you were to hire a builder and build a house. So we are kind of stuck with the inventory that we have at the moment, and this is also why we are stuck with that market situation. Remember that picture with supply and demand that I had a few slides ago? That's basically where we're stuck. All right, so what does that mean for our national home prices? Here's the latest average of the 7 forecasts that we're keeping tabs on. Average is at 10.3 for this year. I think Milwaukee will come in just a little bit below that forecast. Wisconsin is usually not in the top tiers when it comes to national home price appreciation. So we're a lot lower than Texas or Florida, for example, but we are still seeing a strong year for this year, and we're also expecting another growth year in home prices for next year, even though the home price appreciation next year may not be as strong as we have seen it in the last 2 years. But I think we're still going to being up, just because we don't have enough houses. So here is one thing that, if this is the only thing you take away from this video this month, then we have an opportunity coming up in September and in October. It's very difficult to predict the market. It's very difficult to predict the future. Nobody can really do this. But there's one thing we can count on in Milwaukee, and that is winter. And the Milwaukee real estate market has a very strong seasonality. I'll just give you the cliff notes. If you really want to understand what's going on here, I just posted a video a couple of weeks ago that goes into the details. This is only the summary slide, but I think it is so important for you to know this that I want to refresh your memory quickly on this. So what do you need as a buyer? You need a good amount of inventory to choose from. You need prices to be a little bit lower. You don't want to buy in the most expensive time of the year, and you want a little bit of an ability to negotiate. And when you look here at the green boxes, that is always here August, September, and October. In these charts, winter is in the middle. That area here is the cold period. So you can see we're right here. Number of listings is coming down now, and you've seen that early on that this is happening here this year as well. So it's coming down, but inventory is still relatively good compared to the rest of the year and compared to what is going to be ahead of us. Because look at this here, it takes us until April before inventory is going to recover again. So the choices are going to be very limited during winter. Then list prices are coming down a little bit here. You can see the trend. We're also observing it this year again. And finally, the ability to negotiate. So we have your sold to list ratio, and that is coming down very, very quickly. So you take these three things and you line them up, and I can't predict what's going to happen in the future, but I can tell you that every year we have been observing the same pattern, that September and October and a little bit into November are usually a really good time to buy, because you have the inventory, you have the prices, and you can negotiate a little bit, and all that happens before winter. So no, I'm not telling you this because we need more business for the next months. I'm not going to tell you in January that it's the best time to buy now, because in January we will have very little inventory. This is just a seasonal pattern that we see every year. All right, so what can we expect for the next few weeks? I think there's more inventory in store. I have a few listings coming up in the next weeks, but we're also going to see more listings that are not going to sell quickly. So more than 10 days on the market. And as soon as you see a listing sit on the market for 2 weekends without an offer, you know they're basically a little bit overpriced and they are ready to negotiate. But overall, still a very strong market. So if you find a listing that looks just stunning, be prepared to offer 5%, 10% over asking price. We are still cruising along on that level. I just looked at the detailed breakdown for the July data, how much people are paying on average for houses, and we are still on that level. So the next few weeks, as I mentioned, are most likely going to be the best opportunity that we have seen this year so far. Definitely a much, much better market, a much healthier market now than we have seen earlier in the very frantic spring market. All right, so I have one more slide for you, and this is a little bit tooting my own horn. So we have just received a national award from RealTrends. So this is independent from my brokerage. They're not associated with Keller Williams. And they have rated our little team here, On Point Realty, being in the top 1.5% in the nation. So that is a huge compliment. And I was a little bit shocked when I found out about that. But of course, I'm very, very proud and happy to see that the hard work paid off. You don't get there if you have a 9-to-5 mentality. And we're really, really happy that worked out. We're also number 37 ranked number 37 in Wisconsin. So that is a great success, especially considering that basically last year our team was Casey and myself, and of course our kick-ass admin and transaction coordinator, who was a huge help. And thanks to all of you, we have received a lot of referrals from you, friends and family that we were able to work with, and that has really fueled our growth last year and also this year. So thank you very much for this. I'm very proud of this result here, and hopefully we can do even better next year. So thank you very much for watching, and I'll see you next month.